But if you look at the names that are direct plays, if you look at Cat Tractor, or if you look at Steel, or if you look at United Rentals, they really took the brunt of the hit when it comes to the sell-off. So these things were not immune to any sell-off. It was not a rescue. It was not a cure-all pill talking about infrastructure.
Right. It's not, but when they've got a bunch of money coming, they don't have, they got swept up with everybody else.
And when you look at the direct investment from the federal government, it's $200 billion. So the rest of it is state and local communities, local governments. So maybe they don't think it's going to be as quick of an injection of cash as people had once thought when it was shovel-ready jobs.
Well, we remember the shovel-ready jobs, but we also know a lot of people have poo-pooed the impact, and the stocks haven't really run up massively. Is it possible that they're actually underappreciating what could come through here if you take a much longer-term view? I know at least Strategas is sort of more bullish than the stocks are on what funds may actually flow.
I think if you really believe that this is going to filter through, $1.5 trillion is a big deal to get excited about. And he had thrown out, President Trump had thrown out that deal January 24th, and when he had originally said $1.7 trillion, and then it backed off. But the Democrats, I think the key to this is that infrastructure is usually bipartisan. The Democrats threw out their bill, $1 trillion, but it is 100% basically
government
of federal financing. So I think somewhere in the weeds, somewhere in the granularity, this will all shake out, and with the potential to be as bullish as Strategas might be on it.
The interesting thing about this, Mike, too, is the nature of it. To your point about the granularity, I mean, they're talking about funds that, might come from privatizing Reagan and Dulles and Newark, and then reassigning those funds to the local authorities to then invest. I mean, so when we talk about ways to invest around this could be very different.
And I think that's one of the reasons that's a little, maybe too many moves down the chessboard to figure out if today we're going to price something in a dramatic way. Remember how the market was with healthcare? It was only in the latter stages of, is it really going to happen, that some of the stocks started to have a give and take on the headline. So I think we have to see how the process, and we have to see how the process actually plays out to know if that's the reason you either like or don't like some of these names.
Right, so you might have had a Masco, a Vulcan moving on this kind of prospect today, but how would you be playing it then, Steve?
So I think the fact that they were hit so hard during that sell-off, I think you have to be wary of playing the infrastructure play as a whole. If you believe that now these risk parity funds or the CTAs can help on the way up the same way that they hit us on the way down.
Are people saying that?
Yeah, they are now. So when you look at the way that we traded up, if you believe that they were the reason why we traded down, you have to believe in the inverse. So I'm surprised that it actually took a couple of days to figure out, because it was passive investing.
But if
that helped.
Right, you're saying we're going back to the melt up. If we go back to the way things were coming into this year, we are going back to the melt up.
If the CTAs and the risk parity guys caused the sell-off, and now all of a sudden the right back to where we were thing, of course that's one of the reasons. But it's frightening on both sides that no one understands the risk parameters of this marketplace that the computers are feeding into their calculus, that all of a sudden you could be up 300 points and something flips a switch based on volatility.
If we go back to the kind of market that we just had, that's a little scary itself.
Yeah, I don't necessarily think that would be your bet, and for one reason only, if nothing else. First of all, I'm not sure those guys were 100% the core
definitely
driver.
Not 100%.
But the other piece of it is, how do we get to that point where we can be so susceptible to a volatility shock? 14 months of no 1% down days, no 3%. So now the machines that learn what the patterns are no longer building in this idea that we never go down.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.